Welcome back. Is AI in a bubble? Well, we're going to be discussing that. We're going to be hearing from Jeff Bezos as well, discussing that he thinks that AI is in a bubble. And it's not just Jeff Bezos. We're seeing more and more reporting of the biggest sign of an AI bubble is starting to appear. And in today's video, we're going to be exploring what this AI bubble looks like, what it means, and how we can take advantage from an investment perspective. Whether there is an AI bubble, whether there isn't, because here's the deal with bubbles. It doesn't mean that they're going to stop. It just means that there's a risk of a bubble getting popped. But a bubble getting popped is probably the best thing for any investor because that presents opportunity. And that is what we look for on this channel. We look for opportunity to invest, opportunity to exit markets, opportunities to look for in the future to build our financial portfolio, protect our financial future, and most importantly, make sure that we have enough for retirement. This is the Cryptoviser podcast. We talk about everything crypto, blockchain, investing, and sometimes we talk about the macro environment and do deep dives like we're doing today in the AI bubble sector. Make sure you guys are subscribed to the channel. That way you never miss a new video, and give the video a free thumbs up. Let me know what you guys think down below in the comments, and let's get right into today's video. So what is this AI bubble about? And by the way, I'm going to show you that even the big wigs in the AI world, like Sam Altman, like Jeff Bezos, they actually do think that we are in an AI bubble. But what is a bubble? Well, debt is the canary in the coal mine for market bubbles. Housing debt fueled the global financial crisis. Corporate debt led to the dot-com bust. Now, tech companies driving today's bull market are quietly levering up, sometimes through private lenders that make their debts less visible to shareholders. And so, why does this matter? Well, the debt and how it's getting structured is almost an acknowledgement that this is getting out of hand, according to the managing director of Global Macro at TS Lombard. Regarding returns on AI expenditures, big tech firms say they don't care whether the investment has any return because they're in a race. Surely that in itself is a red flag, according to him. He sees two major issues: increased leverage to fund costly AI infrastructure, and also few opportunities to make money once that infrastructure is built and paid for with debt. Now, there's a few different categories that we have to think about AI, right? You have ChatGPT, Grok AI, Gemini from Google. These are the software or the front end, the large language models that are the AI, right? But we also have the infrastructure plays like Iris Energy, Cypher Mining, Bitfarms, all of these Bitcoin mining companies that have now pivoted to AI because they have energy. You also have the energy sector, right? Because these AI, the compute power needed for the machines to actually process all the data and come back with responses, this takes a lot of energy. Similar to Bitcoin mining, right? Mining Bitcoin takes up a lot of energy as well. And so the play is not just Bitcoin, it's also the Bitcoin mining companies. Because yes, they make money, but they need to run the network. So the idea is they're getting paid in Bitcoin, and if the price or the cost of mining goes up, well, the price of the crypto goes up with it. At least that's the idea. And the same kind of dynamic we're starting to see at play here with AI. So big tech is turning to private debt markets and special purpose vehicles. But what is the catch? That kind of borrowing doesn't have to be reflected on their balance sheets. Meta is seeking $29 billion via private capital for its AI data center build-out. Other tech giants are tapping the public market for debt. Oracle recently issued $18 billion in debt to fund their AI and infrastructure expansion. But plenty of strategists have reminded Axios of the old Keynesian adage of the market can stay irrational longer than you can stay solvent. In other words, this tech-driven bull market could still have legs to create more wealth before the bubble bursts. But the director of global macro that we heard from earlier, he is not convinced. He said, I wouldn't touch this stuff now. We're closer to 2000 than 1995 when we're talking about where we are from the dot-com bubble burst. So there is a lot of debt. I mean, another company that I would put this in the same category maybe a decade ago was Uber, right? Uber still barely makes any profit, but for the first 10 years of its existence in a publicly traded manner, they made no money. They were constantly in the negative, meaning they had to borrow to pay things off, right? But they kept expanding because they were in a race. And AI is in the race to keep the US at the forefront of AI, right? But now we're also hearing MarketWatch says that AI bubble is now 17 times bigger than the dot-com boom and 4 times larger than subprime crisis, according to analysts. George Gammon just recently highlighted this new announcement that we heard at the beginning of October 2025 that OpenAI is now committing to invest billions of dollars in AMD, the chip maker. But remember, OpenAI, they don't make any money yet. So how are they investing billions of dollars in AMD? He said from the CNBC article discussed the increasingly circular nature of the AI economy. They conclude with OpenAI is anchoring the demand. He said, I like to remind people, OpenAI loses billions of dollars every year. And so now we're starting to see a flywheel being created, or they call it the circular nature, circular investing, where one company invests in another company, and that company invests in another company, and that company invests in the first company. So they're all just borrowing and lending the same pool of capital to and from each other, and nobody's actually making any money. This is the definition of a bubble, if you think about it. This is the same thing that occurred in 2021 into 2022 with FTX, Celsius, Voyager, 3 Arrows Capital, BlockFi, Terra Luna. They were all borrowing and lending the same pool of money to and from each other. And that pool of money was your money. It was the customer funds. And so that's what we're starting to see. And it's not just OpenAI and AMD. Just a month before that announcement, NVIDIA said they're going to invest $100 billion in OpenAI to expand their ChatGPT makers' computing power. So this was reported also at the end of 2025. NVIDIA will invest $100 billion in OpenAI as part of a partnership that will add at least 10 gigawatts of NVIDIA AI data centers to ramp up their computing power for the owner of the artificial intelligence chatbot ChatGPT. They said this partnership complements the deep work OpenAI and NVIDIA are already doing in broad network of collaborators, including Microsoft, Oracle, SoftBank, Stargate partners focused on building the world's most advanced AI infrastructure. Those companies pledged to invest at least $100 billion in building data centers for OpenAI in January. So those companies are investing $100 billion, NVIDIA is investing $100 billion, and then AMD is, or OpenAI is now committing money to AMD. So they're all basically in a circular nature, right? One is giving money to the other one, then the other one is giving money to the other one, then the other one is giving money to the other one. It becomes a flywheel effect. But guys, I mean, from a money-making perspective, there's a lot of opportunity here. In bubbles, you see, as George Gammon says, the infinite money glitch continues. And we saw AMD stock, just based on that announcement, go up from $165, and it went up 40% in 1 wick, up to over $200. Just based on the announcement that OpenAI, which doesn't make any money, all the money that they're using is just debt, is going to AMD. And then AMD is going to create chips, and it's going to go back to OpenAI. And then, this is the flywheel effect, circular investments, as they call it. This article explains it much better than I probably can. NVIDIA's $100 billion OpenAI bet and the risk of circular investment in AI infrastructure. So beneath the headline-grabbing initiative lies a risky financial strategy rooted in what they call circular investing. NVIDIA is directing large capital flows into OpenAI, which in turn will spend a substantial portion of that capital on NVIDIA's products. Okay, so think about that. NVIDIA is giving money to OpenAI, and then OpenAI is giving the money back to NVIDIA to buy their products. So did NVIDIA actually make any money? Technically, yes, but technically no, right? This self-reinforcing loop echoes the problems of past tech investments, most notably Cisco's vendor financing boom in the late 1990s that ultimately led to market instability and financial distress. Now, I'm going to scroll down to where they talk more about the circular investment, right? Additionally, such large scale circular investments heighten concerns of an impending AI bubble, where capital inflates valuations beyond sustainable levels. Whether it's over optimistic expectations for AI's growth or the financial engineering behind these massive infrastructure projects, the risk remains that a correction could wipe out significant capital and erode confidence in the industry's long term prospects. And I would agree. They also talk here the NVIDIA OpenAI partnership, while unique in scale, fits in with a broader AI infrastructure ecosystem that includes key players like Microsoft and Oracle. Yet the circular financing model and customers' linkage make this case a bellwether for emerging risks in tech investment strategies. It says the parallel with Cisco's vendor financing saga illustrates the importance of balancing visionary technology investment with rigorous financial discipline. NVIDIA's circular investment in OpenAI embodies both immense opportunity and embedded fragility. And so, again, I'm not saying that the bubble is ready to be popped or that we're even going to have a bubble pop, right? Because right now they're just trying to create this product at all means necessary. But there's risk here. There's a lot of risk. And it's not just me saying this. Even Sam Altman sees AI bubble forming as the industry spending surges. And this is from the middle of 2025 in August. OpenAI CEO Sam Altman has reportedly said that he believes AI could be in a bubble, comparing the market conditions to the dot-com boom in the 90s. He said, "Are we in a phase where investors as a whole are overexcited about AI? My opinion is yes," he said. "Is AI the most important thing to happen in a very long time? My opinion is also yes." These are direct quotes from him. And so Alibaba co-founder Joe Tsai and Bridgewater associate Ray Dalio and Apollo Global Management chief economists have all raised similar warnings. And so Sam Altman warns that the AI industry is due for a spectacular implosion, saying there will be booms and busts. He said between the 10 years we've already been operating and the many decades ahead of us, there will be booms and busts. People will overinvest and lose money, and underinvest and lose a lot of revenue. He said, we'll make some dumb capital allocations, but over the arc that we have to plan over, we are, meaning the long period of time, we are confident that this technology will drive a new wave of unprecedented economic growth. And so he said, when bubbles happen, smart people get overexcited about a kernel of truth. Are we in a phase where investors as a whole are overexcited about AI? My opinion is yes, he said. And so, yeah, I mean, this is Sam Altman saying this, not me saying it. We also are hearing OpenAI board chairman Brett Taylor says we're in an AI bubble, echoing what Sam Altman said. And so he said, I think it is both true that AI will transform the economy, and I think it will, like the internet, create huge amounts of economic value in the future. I think we're also in a bubble, and a lot of people will lose a lot of money. I think both are absolutely true at the same time. And there's a lot of historical precedent for both of those things being true at the same time. And so the takeaway that I have, right, is the dot-com bust. A lot of people lost money, but the internet kept growing. And now the AI bubble, everybody is jumping in because it's the best new thing and they think that they can make a lot of money. And don't get me wrong, you can, right? Because we just showed you AMD. It went up 40% or 40% in one day. NVIDIA is the largest company by market cap in the history of the world, right? It's a larger market cap than all of crypto combined. But just because if we do have a bubble burst, it doesn't mean that AI is going away, the same way that all the over leverage and all the over investing that we saw in 2021 in crypto in Celsius, Voyager, 3 Hours Capital, Terra Luna, BlockFi, FTX. They all collapsed. They're no longer around. But you know what is still around? The crypto technology and the crypto coins and the blockchain. And it's bigger and more integrated than it's ever been. So this is opportunity. Number one, to make money on the way up. Number two, to look for the signals that the bubble is popping whenever that does occur. And then another opportunity to get in after the bubble bursts. Because we know that this technology is not going anywhere and it's just going to continue to grow. So that's what they're saying. Over the long arc of time, AI is going to continue to advance, regardless of where the market does in the short term. And so that's really important to understand about this whole AI bubble conversation. Now, this user, Nick, who is an investor and serial founder of AI machine learning, co-founder of DVC, he said, I've answered this question about the AI bubble so many times in the last few months, so I decided to make slides. What is different this time? In the dot-com era, infrastructure was outpacing adoption by 100,000x. New business models that required consumer behavior shifts. Startups and infrastructure companies were driving the market. And slow-paced proprietary innovation, no application layer for internet companies. In the AI era that we're in, infrastructure is used for inference versus research for the future adoption of the technology. Proven business models with existing demand, but AI makes things faster and cheaper. Incumbents with existing distribution drive the market. Fast-paced open source innovation and knowledge transfer, and incumbents and startups building applications layer AI. He continues saying most capital in the world is controlled by 1% of asset managers that just can't write small, under $100 million checks. And so if you look, why are multiples so crazy? The total assets under management by asset type, $21 trillion in AI. Investors understand AI is the game changer, but the vast majority of investors aren't equipped to work with venture capital deals, small, high-risk, high-reward private company deals, reliance on power law returns, and high competition. He continues saying, so they write checks only into large public companies, public and private infrastructure projects, foundational model labs, and a dozen breakout app layer companies that are big enough to accept $100 million checks, meaning they can only invest in the biggest. They can't invest in these small ones. But the app layer companies don't need as much money, so competition for good startups is insane. He says, why? So they invest in what they can. Large publicly traded companies and private infrastructure projects is lower risk and higher capital intensity. Betting on incumbents is a reasonable strategy for typical portfolio strategies expecting double-digit returns from each bet. Foundational model companies, the higher risk, higher return, large capital intensity, and a decent selection of targets. And then larger breakout application layer companies, despite AI app layer being young, a dozen breakout companies have reached $100 million plus in revenue and are able to accept $100 million checks from large investors. The insane competition for deals drives late-stage multiples up, which are then inherited by early-stage venture capitalists. And then he says, to close this out, even if the market's correct because of external or macro forces, AI is still going to do fine. And so like I said earlier, like the AI bubble is in the investment side, not in the technology. That's very important to understand. And so now that brings us to Jeff Bezos saying that investors usually don't give a team of 6 people a couple $1 billion with no product, but that's happening today. Like we just said, right? They can only cut large checks. So they're cutting large checks to these very small companies that have nothing yet. But they realize they have to give them the money to be able to create right? It's like a blank check company, right? To create what they're trying to create. Let's listen to what Jeff Bezos says here in this interview. We're going to play it at 1.5 speed. This has been kind of getting around on social media recently, and I figured this would be a great opportunity to bring it to my viewers and really understand what this AI bubble means and what we can do from an investment perspective to capitalize on it. And this is what we do on this channel almost every single day of the year. We post videos, and sometimes we do deep dives like we're doing today, and sometimes we talk about the global macro environment in the financial markets. So make sure you guys are subscribed, give this video a free thumbs up, and let's listen to what Jeff Bezos says here.
Well, okay, so to take you back in time, in the year 2000, when the internet bubble burst, Amazon's stock, in a very short period of time, went from $113 a share to $6 a share. And by the way, it's split many times since then. I don't know, 20 for 1 or maybe even more. I don't have the number. But so these prices have nothing to do with today's stock prices. But to go from 113 to 6 in a short period of time was very concerning. And shareholders were upset, employees were nervous. All of our employee base, their parents were all calling our employees and saying, "Are you okay?" You know, this was the environment of great nervousness. But I looked at the numbers in the business. And every month, as the stock price went from 113 to 6, a number of customers went up every month. Our gross profits went up every month. Our operating expense, we were still in a loss position, but our losses as a percentage of sales went down every month. Every single business metric, new customers, customer repeat purchases, everything that we were monitoring through that entire period kept getting better. And so that's one observation about bubbles in general. The fundamentals can be disconnected, the fundamentals of the business. And of course, as entrepreneurs, you're focused on the fundamentals of the business. The stock price is an output, an ultimate output that you actually have very little control over. Benjamin Graham, the great...
Now I'm going to pause here for a quick second, because what Jeff Bezos is saying is what we talk about in this channel, right? Fundamentals are different than pumpamentals. Pumpamentals have to do with the stock. The fundamentals have to do with the underlying business. And so if you look right now, what's happening with many of these Bitcoin mining companies that converted or pivoted to AI infrastructure, like Iris Energy, Cypher Mining, Riot, TerraWolf, Bitfarms, we're seeing these stocks, soar, right? And nothing really fundamentally changed in their business model, right? Their business was high-powered compute, large quantities of energy for Bitcoin mining, and now they're just moving it over to AI. So is the value necessary to be going up this high? Well, we also have to think about supply demand, right? The fundamentals show that there's very high demand for this compute power for AI, but there's very little supply. Now that's going to be offset as more investments occur, right? We talked about Meta building out their AI infrastructure, OpenAI building out their AI infrastructure. So over time, the supply is going to increase while the demand increases and hopefully get into balance. And that may cause, the bubble to pop, where some of these stocks that have been going up parabolically do come down, including the chip companies and the chip makers. But the fundamentals of their business, right? You heard Amazon went from $100-something down to $5. It's like a 95% drop. But they were still making money. They were still operating, a business that was going to grow and expand over the course of time, right? That was still the trajectory. And so no matter what happens with these AI companies from a valuation or a stock perspective, we know that this is going to continue to grow. Maybe they're not all going to win, right? Some of them will probably fail. But the industry is still going to grow. And so this is a great opportunity to look for the bubble to pop or for a corrective phase to occur. And if you see that and you're still bullish, that's the entry point, right? If you could get in at $6 in Amazon after it dropped 95% from over 100, why would you not do it? This is what we talk about in crypto all the time. People are like, no, Cryptoviser, there's no more 4-year cycle. The Bitcoin price is going to go up forever. Over time, yes. But in the short term, we are going to have corrective phases. And if you're not prepared for those corrective phases, you're not going to be able to buy. You're not going to be prepared to buy. You're going to get into the fear mode when it does drop. What we do on this channel is we prepare by understanding AI could be in a bubble. And if it is in a bubble, we are due for a corrective phase at some point in the future. When that corrective phase occurs, we can capitalize on the downside by shorting or buying puts or whatever the situation is. But then we look for that bottom to be formed. As Jeff Bezos said, that $6 price or $5 price in Amazon. Buy. Let's continue listening to Bezos.
Investor is famous for saying, in the short term, the stock market is a voting machine. In the long term, it's a weighing machine. And so as founders and entrepreneurs and business people, our job is to build a heavy company. We want to build a company that when it is weighed, it is a very heavy company. We do not want to focus on the stock price. And so that is, that will be misleading because it can be disconnected from the fundamentals. And when bubbles happen, so that's one thing that happens. The second thing that happens when people get very excited, as they are today about artificial intelligence, for example, is every experiment gets funded. Every company gets funded. The good ideas and the bad ideas. And investors have a hard time in the middle of this excitement distinguishing between the good ideas and the bad ideas. And so that's also probably happening today. But it doesn't mean that anything that's happening isn't real. Like, AI is real, and it is going to change every industry. In fact, it's a very unusual technology in that regard, in that it's a horizontal enabling layer. Today we talk about AI-first companies like OpenAI and Anthropic and Mistral and so on and so on and so on. There are so many startup companies that are kind of AI companies of various kinds, and that's normal for this phase. But that is not the biggest impact that AI is going to have. The biggest impact that AI is going to have is it is going to affect every company in the world. It is going to make their quality go up and their productivity go up. By every company, I literally mean every company, every manufacturing company, every hotel, every consumer products company, et cetera, et cetera, et cetera.
Now I'm going to pause here for a second because we talk about crypto on this channel a lot, and it's a same correlation. Just because the hype in crypto is way too high, right? And I may say that we're at the end stages of the cycle. People are like, no, but the technology is getting integrated and the banks are using it and the government is buying and all of this stuff is great. And none of that changes just because the price goes down, right? But sometimes there's too much investment. Companies are not going to continually put billions and billions to keep buying more and more Bitcoin or keep buying debt so that another company can go buy Bitcoin when they could just buy the Bitcoin themselves, aka these digital asset treasury companies. And so I'm not saying over the long term, like the technology is going to be integrated. Blockchain is going to be integrated. It's going to be adopted by more. Bitcoin is going to be adopted as a store of wealth by more people. These digital asset treasury companies will probably be as well. Some will make it, some won't. Some cryptos will make it, some won't. But to think that the price coming down means the technology is going away is ridiculous. They're two different things, the technology and the valuation. That's exactly what Jeff Bezos is saying here for AI. Some of these companies will survive, some of them won't. Some of them are going to be around in 5 years, some of them won't. Some of them are going to get more investment and get higher valuation, some of them won't. But the technology is going to continue to grow, and it's going to continue to get integrated. That is the point. So that these are winners over the longer term. You look for the fundamentals, look for the companies that are continuing to do things that are making money. That way, if you do have a corrective phase in the market, that bubble getting burst, however long it takes, whenever it does happen, you can get in.
And so that is hard to fathom, but it's real. There is no doubt. We don't know how long it will take exactly. We don't know how quickly that transition will occur. It'll probably occur at different rates in different industries, but that is very real. Now, what the stock market does, which is when we think of bubbles, we think of valuations and market caps and things like this, and how many billions of dollars are being invested in these 6 people at a $20 billion valuation, even though they just started yesterday, right? That's very unusual behavior. Investors don't usually give a team of 6 people a couple of $1 billion with no product. It's rare, and that's happening today. But the great thing about industrial bubbles, this is a kind of industrial bubble, as opposed to financial bubbles, and I'll tell you what I mean by that. If you go back, like the 90s had a biotech bubble, and there were a bunch of pharma startup companies that were designing drugs and using new techniques, and the world got very excited, the investment world got very excited. As a group, they all lost money, but we did get a couple of life-saving drugs. A bubble like a banking bubble, the crisis in the banking system, that's just bad. That's like 2008. And so those bubbles society wants to avoid. The ones that are industrial are not nearly as bad. It could even be good, because when the dust settles and you see who are the winners, society benefits from those inventions. They still get those life-saving drugs. And that's what's going to happen here too. This is real. the benefits to society from AI are going to be gigantic.
And if we go back 25 years ago, when the internet was in that bubblish moment, no one would have predicted a lot of the industrial benefits of that industrial bubble. And the fiber, huge investments that were put in infrastructure.
It's a perfect example. That all of that fiber optic cable that got laid, and by the way, the companies who laid all that cable went out of business.
So this is the perfect explanation for what this AI bubble is, where it's going, and for us on this channel, it's looking for the opportunities, right? NVIDIA may not be around in 10 years. It may not be the most valued company in 3, right? But we know that there are going to be winners. There's going to be infrastructure plays. There's going to be the software plays. There's going to be the developer plays. And these bubble bursting allows us to consolidate. Some of these companies will be bought by other companies. Some of them will go away. Some of them will be, the technologies will be picked up by these other companies and bought out. But we need to look for these things and look for which companies have the fundamentals and continue to have the fundamentals through a bubble burst. That way, when the bubble does burst, and these and strictly talking about valuation perspective, we can enter, right, and say, okay, like for instance, NVIDIA, you can see this at the beginning of 2025, we had a major drawdown in the price, right, from $150 down about 32%. This is a major, or 40%. That's a major drop, almost half in valuation. And those are the opportunities that we are looking for to re-enter. And since then, right, since that 40% drop, we're now up 100%. So we not only recovered what was lost, but then doubled it. And that is the way to invest. That is the way to invest and understand fundamentals versus pumpamentals, especially with the AI bubble. Let me know what you guys think about this. Let me know which individual stocks or companies that you think are investable during a bubble burst. Which companies do you think are going to be affected by the bubble? Let me know down below in the comments of this video. Don't forget to give the video a thumbs up. Hit the subscribe button. I'll see you guys on the next video. Invest responsibly and crypto on.